What is being talked about a lot today is AI and also NVIDIA, which is, of course, part of AI. I'm going to cover AI, and I'm going to cover the Magnificent Seven, which includes NVIDIA, and how this relates to what has happened in the last 100 years and even the last 400 years. Hi, I'm Ben Reppond. Welcome to my YouTube broadcast. Today is February 27, 2024. I'm going to begin with an interview that Andrew Sorkin does with Dan Niles. And Dan Niles proposes, this is just positioning, this is not official. He proposes that the Magnificent Seven, this would be Apple, Microsoft, Amazon, Google, Tesla, Meta, and NVIDIA, have, in his mind, have become the fabulous four, which means that he is dropping three out of the Magnificent Seven. Wow, we just, what was it, a year or two ago that we were talking, maybe 2.5, we were talking the Magnificent Seven, and no longer. He says, no, I think it's the Fabulous Four because there are three of them. While they have done well, three of them have done less well. So the three that he drops out are Apple, Google, and Tesla. As I looked at those individually, Tesla was struggling the most. Google and Apple are not doing as well as the remaining four. But they're not doing horribly. But here we have four that are kind of surging, and they are all tied to the AI space. Of course, NVIDIA, even more so. But Amazon, Microsoft, and Facebook definitely are tied to the AI space. So I'm going to play this, and then I'm going to do a historical look over the last 100 and 400 years to show you how this is not new. It is not unique. But so take a listen to this. I think it's instructive. Dan Niles has a very good reputation on Wall Street, and Andrew Sorkin does a good job interviewing him. Take a listen.
Our next guest saying the Magnificent Seven should be rebranded the Fantastic Four. On that list, Meta, Amazon, Microsoft, and NVIDIA. That stock pointed more gains in the pre-market this morning. This after a 16% spike yesterday, juicing markets all around the world. Joining us right now, Dan Niles, founder and senior portfolio manager of the Satori Fund. Good morning to you. I was going with the fancy four. Fancy four.
I like the word fancy.
Well, I'm a superhero fan, so I had to go with the Fantastic Four. So what can I tell you?
I hear you. But why don't you just explain why you're taking three off the list? I'm curious about, actually.
Well, I think if you look at the last 2 years, really stock prices were driven by the Fed. So you go back to 2022, the Fantastic or the Magnificent Seven, as they called them, were down 46% during that period of time. And that was because we had the fastest rate hikes in history, had very little to do with earnings. You go back to last year, the Magnificent Seven were up 111% over that same period of time. Again, not really earnings driven. Every stock went up because Fed was on hold. People were at one point expecting up to 7 rate cuts. And so multiples expanded across the board and stocks ripped. Right now where you are is earnings seem to be driving a differentiation among these names. So Apple, after they reported their December quarter, estimates went down again from March. For Tesla, similar situation. And if you look at Google in that group, they did well in their AI-related business, Google Cloud, but their big business, which is search, which is what they're known for, and YouTube, both of those categories missed. Meanwhile, you had Meta blowing out numbers. If you look at those three that I dropped off the list, that's what they all have in common. The earnings are struggling. They're having issues with competition. And I think you're seeing that in the stock prices where Apple, Tesla are both down this year. Google's underperforming the market. And then the Fantastic Four are absolutely doing great because the numbers for 3 of the 4 went up a ton. And, Microsoft, obviously, ChatGPT, they own 49% of OpenAI, massive benefit for that for them. So that's why we've dropped those 3 off the list. It's competition issues.
Okay.
So as I listen to all of this and I think about this Magnificent Seven, it was about 2 to 3 years ago, maybe 2.5, where Google and Apple and Tesla, and you could even throw in probably Netflix, were really the darlings, and including Microsoft, Amazon, Meta, etc. But the 3 that are being kicked out, it was very recently that they were the darlings, and especially Apple. And you just wanted always on Apple. And now he's kind of kicking them out, saying, no, there's a new game in town. Well, as I look back over history, it just reminded me so much of 2008, but really more of 2000, where we were dealing with the dot-com issue. And what was happening then, as you may recall, if you were around then, that technology, dot-com in particular, was in favor. And all you had to do was have a business model of some sort, put .com after your name, and your stock skyrocketed. That's what it seemed like. And every day you woke up, you go, okay, it's up again. This was 1999. It's different today in this way. It's different in that these are significant companies. These are huge companies with excellent earnings and growth in earnings. So that's different than 1999. However, what's not different is the human emotion. So that's what goes on here, is human emotion tends to chase what is hot. And so right now, they've been chasing the Magnificent Seven. Maybe if Dan Niles is right, maybe they'll chase the Fabulous Four. They'll drop off the other 3. This is a speculative game. And there's nothing wrong with it from this standpoint. First of all, I hope you don't put most of your money in this. But secondly, it trends, it moves up until it doesn't. So right now, it is trending up. I have no problem riding that trend. We're doing it as well. And I hope you make money. I hope we make money. But I do know that what happens is it runs out of steam. And he proposes that it's because of earnings start to soften, they don't meet these sky-high expectations, or new competition comes in, or there's new technology that comes along. So what human emotion wants to believe that we don't think this is going to the moon, but we sort of act like it. And so it brought me back to 1999, but it also, as you go back further, I went back to the post-1950s, the pre-1950s, and then went all the way back to the 1600s. So to look at this is the same. It's not about this stock or that stock or technology versus another technology or changing technology. It's not about that. It is about human emotion from an investment standpoint. So I looked at the kinds of companies. Now, these were not high flyers. These were not, like AI stocks, screaming, but they were going up a lot. These were the companies that were in favor and were quite attractive. And if you were following the trend, a lot of people jumped on board. And I wrote down some names, and it just literally just came to memory. When I go all the way back to 1634 or 1634 to 1637, I looked at tulip mania. Now, we've heard of the tulip mania in Holland in the 1600s. This is a very going economy, a lot of wealth and so forth. And there was a unique tulip bulb developed, and the tulip would develop from the bulb itself, and it was kind of a unique technology, so to speak. And so people jumped on board, particularly the wealthy. And then they sucked in, because people were just making money hand over fist as the prices were going up and up and up, that this was the way to get these unique tulips that had never been thought of before. So people piled on. And so the average person, I mean really the average person, down to household maids and servants. And so they literally, these people put all of them, including the wealthy, put a lot of money in there. And the cost of a bulb was around the price of a house today. So it got as high as about $750,000 per bulb in today's dollars. So you say, oh, that's crazy. I would never do that. They must have not been very smart. No, they were very smart. They were just as smart as us. And what they saw was the opportunity to make money. Every day, the price of bulbs was going up, day after day, week after week, month after month, and it just sucked people in. It's human emotion. It would suck many people today in, no matter what it is. So I thought of, here we are, AI, same thing, sucking people in. I want to get on board. I need to get on board. I understand that emotion. We are on board. We're not doing, necessarily AI, but we are, invested in the market. We're invested in growth stocks. We're doing it mathematically. We don't do it emotionally. But so when the market trends, you want to be on that trend. And in this case, if it was tulips, or if it's Bitcoin, or if it's AI, whatever, you want to be on that trend. But the problem is that we and people, we get sucked in, and our emotions become so attached to this that we start to think we're going to become wealthy. This is going to the moon, or something like that. We don't imagine the phrase going to the moon, probably, but we act like it. So I just thought it was a great metaphor for here we are today with AI, and maybe not with you, but with a lot of people, the inclination to get involved with AI and get on board and think, just put your money down and let it go. Be careful. Be careful. And when you see this chart here, you will see that, yes, it goes very, very high, and then look at the backside of it. It comes down very, very far. To the very far right of the chart, lower right, you can see that little red line across the bottom, and that is the price, the intrinsic price of tulips, not what the speculation was. And the speculation was so high that it is said that the cost of a tulip would be 100 times its weight, because they sold them based on weight, 100 times its weight in gold. Think about that. And if that's where it is here today, this would be going on. And it kind of is here today with AI. So think about it, be careful. When I went back, not as far as 1634, but I went back, in the last 100 years. So this would be more recent history. I thought of companies that were not high flyers necessarily, but they were in favor. They would be companies like General Electric, Sears, RCA, Motorola, U.S. Steel. Those are not hot stocks today. Some of them are even out of business today. But that's an example of what AI is today, and maybe Tulip Mania was in 1634. Since 1950, those are kind of pre-1950, I thought of companies like Boeing, IBM, most banks. Many of those banks, if you go back to 1950, many of those banks don't exist anymore. Warren Buffett, as wise as he is and as careful as he is, has lost 50%, approximately 50% of his money 4 times since 1970. And yet he's a very careful investor, buys deep value, and yes, even those are not high flyers, but yet when he buys them, he knows that at some point he's going to ride this down, and maybe the next time, the fifth time, maybe it'll be another 50%. He knows that. But he's prepared for that, and he discloses that to his investors that this is what you're in store for. I also think of companies like J.C. Penney, Woolworths, the great and amazing Penn Central Railroad. And you probably know the story of Penn Central, and if you don't, it's worth reading. They were started as the Pennsylvania Railroad back in 1846. And the railroad was very, very popular and a very strong stock to buy during the late 1800s, maybe early 1900s. And then competition came along. New technology called trucks and barges came along. And then earnings slipped. And then all of a sudden, the Penn Central Railroad was not what it used to be. I came into the business world at the time, just about the time, right before the time where the Penn Central Railroad went bankrupt. And I remember hearing at that time the story, and because this was once a very powerful company, like AI stocks today, like Tulip Mania, or like U.S. Steel or whatever. These were, the story is this, I'll just tell it to you because it's not around today, but it was a great story of the once great Penn Central Railroad, and of course they had merged with two other railroads at this time, but in the late 1960s, early 1970s, they were struggling with earnings, they were losing money, but on paper, they were worth $50 million. Now that's maybe not a lot, but those were actual dollars then, so in today's dollars, that's more. 50 million, they had net income, profit, of 5 million. They actually had assets of about 5 billion. But they had many bills they could not pay, and one of those bills was the manufacture of the conductors' uniforms. The bill was for $25,000. The bill was 90 days old. They hadn't paid it because they didn't have the cash flow to pay it. So the manufacturer of the conductors' uniforms sued them in federal court, and they could not pay it. And at that point, they filed for bankruptcy. And so it was with the mighty Penn Central Railroad, it was the $25,000 bill from the manufacturer of the conductors' uniforms that actually put them into bankruptcy. So those of you who understand business, you understand that cash flow is everything. Profit, net profit, profit on paper, net worth on paper is not worth that much. Cash flow is what makes the world of business effective. So, yeah. But they were once, if you go back into the 1800s, the Pennsylvania Railroad was quite a railroad. And then I come to a company like Microsoft. Microsoft was began in around, I believe, around 1985, and grew and grew and grew very rapidly for many, many years, doubled in size every year for many years. But then they got to 2000. So when the dot-com bubble hit, Microsoft dropped in value about, I think it was over 80% in value. Many stocks went down 90 to 99%. Most stocks that were in the dot-com space went out of business. Microsoft, because they only went down 80%, was among the more fortunate. So that's Microsoft. And here today, according to Dan Niles, they're in the Fabulous Four. They're in the Magnificent Seven. They're one of the largest companies in the world. They're doing very, very well. But at one point, they dropped 80% in value, having followed a period when they were a high flyer, and they were a high flyer. So when you think of okay, is AI going to be like that? And because the way I read the articles what is being written about AI, they are here to stay. AI is here to stay. Okay, I agree with that. Is NVIDIA here to stay? We don't know, maybe. Are there new companies emerging that may take over NVIDIA or challenge them? Probably. So the kinds of rides that Microsoft has had, or so many of the other companies, Yahoo, Amazon, et cetera, those companies that were around then, it was a terrible, terrible ride. And they have seen way ups and way downs. And here we are with AI stretching to the moon already. Where do you think it's going to go? Probably up quite a bit. But also, believe me, there will be, if history is a teacher, there will be way up and way down. And today, Dan Niles has already taken out Apple, Google, and Tesla out of the Magnificent Seven. Was it not long ago when those were the darlings? And now they're out. There's nothing wrong with them. They're good companies. They're good stocks, but they're not the top ones. I think of this quote by Sir John Templeton. The four most dangerous words in investing are, "This time is different." And that's what we tend to do. It's our human emotion. We want to say that now AI, oh yeah, it's going up a lot, but it's not going to come back down. The companies I talked about have gone down somewhere between 50 and 80%, and some more than once, some multiple times. So the rides that these companies have can go way up and come way down. Just be prepared. If you're investing in AI, just be prepared that yes, it may go way up, and I believe it probably will, but also be prepared that there's another side of this coin. It is probably at some point going to come way down, and you have to be prepared for that. I want to play this. This was a piece that was done by CNBC's Kelly Evans on AI and NVIDIA. And actually, she kind of makes the case for it, but she's also careful to point out that, or the people she interviews, careful to point out that there is a downside. It's just what I just talked about, that AI is strong right now, but be careful. So it was a good piece, a good kind of a commentary that CNBC did on AI and NVIDIA. So take a listen.
The biggest figures in AI, they have just thrown out the B's and started talking in T's. To AI titans, they're now prophesying trillions of dollars in opportunity. Stratospheric predictions from NVIDIA chief Jensen Huang.
And over the course of the next 4 or 5 years, we'll have $2 trillion worth of data centers.
And then there's Sam Altman's ambitious new venture.
$7 trillion.
$7 trillion.
$7 trillion.
He likes big numbers.
That's more than the entire U.S. federal budget, 2 times the UK's annual GDP, more than the value of Microsoft and Apple combined.
It's not even conceivable, of course.
Nobody raises trillions of dollars, first of all.
Altman's response to the critics: you can grind to help secure our collective future, or you can write Substacks about why we are going to fail. Substacks, or in our case, this week's Tech Check, AI's $1 trillion opportunity. NVIDIA's latest earnings report, it crushed analysts' already sky-high expectations for the AI darling.
We start with that massive move in NVIDIA. You're going to hear that name a few times here. Bet the over on this one.
$22.1 billion in sales, that's 10% higher than the street even expected. Forecasting $24 billion for the next quarter, beating estimates by another 10%.
A lot of it, though, is driven by data center revenue. It's bread and butter, which grew 38% quarter over quarter to $18.4 billion.
There had been signs of worry in the market that NVIDIA's stellar run was unsustainable. Shares fell nearly 10% in the week leading up to earnings.
You have to wonder, at what point does something trigger this thing? I mean, the story can't, I don't think, last forever. And double ordering, triple ordering, margins compression as more people get into the space, more competition. I don't know. We're getting close.
Concerned that demand might wane, more competition, and that NVIDIA's chips wouldn't pack the same punch as the industry shifts from something called training to inference. Here's what that means. The first step in developing an AI model is training it, feeding it tons of data, images, video, text. That requires heaps of compute power with those highly sought after NVIDIA H100 chips. After the models are trained, though, the next step is inference. The model is able to start generating its own text and pictures based on that training data. One analyst wrote, demand growth for NVIDIA chips will eventually moderate. AI chip demand will eventually normalize once the initial training build has been completed. The inference phase of AI is going to require less computing power than the training phase. But NVIDIA says it's cornered this market too.
The amount of inference that we do is just off the charts now. Almost every single time you interact with ChatGPT, you know that we're inferencing. Every time you use Midjourney, we're inferencing. The inference part of our business has grown tremendously. We estimate about 40%.
40% of data center revenue from inference. That is 2 times higher than Morgan Stanley estimated. And it crushes the bears' warnings.
So we've been hearing a lot about commercial real estate being refinanced. And in the next couple of years, 1.7 trillion of commercial real estate is being refinanced. Jeffrey Gundlach, the CEO and founder of DoubleLine, wrote this, and I got it off of Steve Blumenthal's blog. And in addition to that, Treasury bonds are also coming due in the next 3 to 6 months. 17 trillion of bonds are coming up. What that's going to do, and the prices on these bonds are definitely, they're down. The interest rates are up. Are people really going to renew this? I don't know. But this is a lot of dollars that are at stake in the U.S. economy for either pulling the dollars out of the economy or remaining out of the economy or pushing them back into the economy. So he says this, the U.S. deficit has been going up, and it's been going up because of higher interest rates, because we, the U.S., we are a borrower of on our bonds. 17 trillion of Treasury bonds come due in the next 3 to 6 months. Hard to imagine. The average interest rate on them is well below where interest rates are today. A lot of them are at 50 basis points. In other words, they have been financed with interest rates of 0.5%. And you have to reinvest those. You're asking the public to reinvest those dollars at 4%, which means the value of the bond goes down, but the interest rate that they pay, the premium they pay, goes up. If you have this, he says, you have an arithmetic problem. In other words, it doesn't work well for the economy. So among the other things that we're facing, which I covered, we are also facing this issue of the refinancing of Treasury bonds, which is going to hit our budget, our Treasury budget, and is going to hit our deficit. I want to cover this again. I've covered this recently. Commercial real estate, big issue. The 1.7 billion, this is just one building, but $1.7 trillion in commercial real estate mortgages are coming due and have to be refinanced this year and next year. And the value of those buildings is down in many cases about 50%, some 40, some 60, but a lot of them is kind of in the range of 50%. And banks are wanting more equity from the owner, and interest rates are higher, vacancies are down. This is not a good picture. So this is part of the economy that we're in. You may think, okay, well, I'm not part of the commercial real estate market, but we all rely on banks. Some of us rely on regional banks, maybe not so much as larger national banks. But a lot of regional banks finance these buildings, and this is going to hit the banking system in 2024 and 2025. I don't think it'll be a complete collapse, but I think it will be a story of some bankruptcies in the banking space between here and the end of 2025. So anyway, it was a good piece that I thought Bloomberg did on the commercial real estate market. So take a listen.
How much do you think you can buy this for? 13 cents. The snag is, it comes with at least $800 million of debt. It's the sort of thing that's happening a lot right now. And that's a big deal. Because a global property crisis can rapidly spread to the rest of the economy. Office buildings, hotels, and other commercial real estate projects around the world are going insolvent or being sold at knockdown prices. One investor has warned that the industry could face $1 trillion in losses.
This is the biggest real estate crisis since 2008. A lot of office space around the world is now redundant. There's too much of it. And that's why we're seeing such massive value declines.
There's a building in Manhattan owned by Blackstone that's being marketed at a roughly 50% discount on the loan. Aon Center, the third tallest building in LA, sold in December for a 45% discount compared to what it sold for a decade earlier.
There's been Chinese developers run into trouble, and some of them have been threatened with the loss of their buildings as well. So this is happening around the world and will continue to happen.
So what exactly is going on? At the heart of all of this is how most commercial real estate projects are funded.
So a lot of these buildings are funded largely by debt.
In a game of Monopoly, you can't make money if a property has a mortgage. But in real life, landlords use rental income to pay for debt. If there are no renters and not enough money, then landlords have a problem, and the banks then loan them the money.
The knock-on consequence for the economy is job losses from those banks, less credit available, which means less investment into things like factories, warehouses, growing your business, and then in turn, potentially further job losses because instead of the economy growing, the economy starts slowing.
Okay. This couple, the guy is sending a message. AI turns this single bullet point into a long email I can pretend I wrote. The couple on the other end, receiving the email, says AI makes a single bullet point out of this long email I can pretend I read. Maybe that says quite a bit. Thank you for watching. If you have questions or comments, leave them in the comment section below.